So somebody in the community just asked this question. SCHD has gone south all year. VOO is up 6%. SCHD is down 6%. Make a video on why SCHD sucks in 2023. Now, somebody who has talked a lot about SCHD on this channel is somebody who has a lot invested in SCHD on this channel. Yeah, it's been a very ridiculous ride in 2023 with this particular high dividend paying ETF. And you got to wonder what's going on with it. Is the glamour and the excitement over? Is it time to move on to a different type of ETF? Or what's the deal here after all? So let's start by looking right over here for the year-to-date price return of this particular fund. Now I'm going to compare it to some of the other ones. First, its competitor VYM, which is the Vanguard High Yield Dividend ETF, the S&P 500 Index, QQQM, which is another favorite one of mine that focuses on the NASDAQ 100, and VTI, which focuses on the entire stock market, which will be very similar to the S&P 500 Index. But take a look across the board here, year-to-date price return. Now you have VYM down 4.37%, S&P 500 up 7.84%, and look at that, SCHD down 7.14% as of the recording of this video right now. This could, of course, fluctuate over time. You'll have to go over to Seeking Alpha and check it out for yourself to see what's going on at the current moment that you're watching this video. But even if we look at it right now in this snapshot, what's going on here? So I could have went in and bought a bunch of VTI, and I'd be up 7.25% on my money. But if you only bought SCHD, you're down. And you're like, what kind of scam is going on here? Stacked on top of the fact, if you would have went in on QQQM, you'd be really looking very good at 22.9% up. There's two things that we need to unfold, and this is my hypothesis on what SCHD has going on. Now let's take a look here at the total return because, total return factors in any dividends that are paid, but it still isn't that good of a picture. You have VYM down 3.69, VTI up 7.68%, QQQ looking great at 23.15%, and SCHD still down over 6%. Now, theory 1 out of 2 is right here. I'm going to highlight SCHD so we can see exactly where this thing lands. First thing is right here. Do you see where this is starting to go down? Let's take a look and hover over that particular drop. Right here it is on 3/8/2023. Now, what happened on 3/8/2023? If you don't remember, we had the banking shenanigans that happened with Silicon Valley Bank, Signature Bank, and ultimately just recently with First Republic Bank, which we talked about here on the channel. But because SCHD does have holdings, as you can see here, the holdings breakdown, 13.51% in the financial sector, well, that's going to cause a little bit of issue. But here's the one thing that is a little bit tricky with Seeking Alpha, and it's actually one of my old videos, and unfortunately, like a dummy, I don't have it as zoomed out as I wish I did, but information technology and financials go off of the screen. But as you can see here, this is back as of 3/31/2021, financials were actually a larger portion in comparison to what we see today, where it's only 13.51%. So this may not be entirely accurate. It could have had a lot more financial percentage, and as a result of the recent issue that we've had, it's reduced its overall holdings. But because of that, irregardless, that's where we might be seeing some of this dip down that occurred in March 8th all the way down through here to about 315. You can see there's a little bit of a recovery here in throughout April and then another dip down. Why another dip down? Well, we had the First Republic issue that also happened. And it's not like SCHD did or did not have these companies in its holdings. Remember that it does have other financial companies such as JP Morgan, Bank of America, Wells Fargo. I think it has a little bit of Schwab in it too. So all of these things, of course, got beaten up based on the fear of First Republic Bank, SVB, and Signature Bank. So naturally, it's going to have a bit of a pullback, and that could be what's also impacting it. There's the other issue here too, though, and that's this beautiful chart right here. So what we're going to look at is you have the different sectors: technology, communication, cyclical, defensive, industrial, healthcare, etc. This is the overall S&P 500 map, year-to-date performance. Now, take a look at all the big green monsters. I mean, it's the things that you know. Apple, Microsoft, you got a little bit of NVIDIA there. You got Google, Meta. Look at Meta up 94% just year-to-date. So, wow, that's remarkable. But here's a little bit of the issue. Financials is looking a little bit bleak. Do you see how down here? Yeah, you got some green here in Visa and MasterCard, but overall, you're either flat or a little bit down, as I mentioned earlier. But also, industrials, they don't look too hot either. Take a look here at this little square. You got some green on GE, but most of what I'm seeing here at the first glance is a bunch of red. We go back here to the overall sector breakdown of SCHD, look at what's here at the top. Industrials at 17.52%, healthcare at 16.65%. Well, if you're looking at industrials right here and healthcare right here, well, that's looking pretty bad. That's what's pulling down the ship, because that's where most of the money of SCHD is currently built up in. Now, over time, that might reset, but remember, it tracks the US Dow Jones 100 Dividend Index. So what it's doing there is going to be relied on the performance of the index along with a few other factors. What's really pulling the boat of the overall stock market right now is going to be your technology, communication, and a little bit of consumer cyclical, as indicated by those bright green boxes. And that is why we saw back here on charting QQQ just kicking butt and taking names, because right now that's where the money is. That's where the stock market is seeing the most growth. As a result, you're going to see a little bit of strength in that overall sector. See, if I look at the same thing here for QQQM, the holdings breakdown is 50% into technology, followed up by 16.5% into communication, followed up by 14% in cyclical. So you hop back here, yeah, green, green, green. It makes complete sense why QQQM is kicking butt, and SCHD, it's not doing as well as it has in the past. But remember, when in doubt, you have to zoom out. And even though we're seeing a great run for the QQQM and the technology stocks and things like that, SCHD is still a strong performer. So here we have on a 3-year up at 55.67%, thereby actually beating the S&P 500 at 43% and VTI at 48%. So that's also an important reason why you also want to diversify your ETFs if you're not just buying into the total stock market index. I like to do a little bit of a dance with dividend-paying stocks with SCHD. I like to have a little bit of an aggressiveness with QQQ. And I like to have a little bit of calmness and conservative focus with VTI. But the bigger question is going to be, is SCHD going to recover from this or be kind of flatlined? Is the goal and the hope and the excitement over, or is it going to be able to eventually self-cleanse itself and get back on the right track? That's what we are going to have to keep our eyes on as smart investors. But let me know what your thoughts are on my theory today, as well as what you think the future of SCHD is going to be by dropping me a comment down below. Check out this video next on SCHD and JEPI, and we'll see you on the next video.